everyone, a very good evening. It's 5 p.m. on the clock, which means it's time for the Money Show, your daily dose of personal finance news and tricks to follow. I'm Mobina. Let's tell you what we have lined up on the show today. During this lockdown of roughly about 5 odd months, yes, we've all had to go through quite a bit, but I guess the one positive that has come out is that our lifestyle expenses have decreased, which means no more hanging out with friends. That's of course the bad bit, but no more spending the money that comes along with it. No dining, no eating out, no watching movies. No vacations either. And if you are a student, a post-grad student who had their hopes pinned on traveling, abroad for your education this semester onwards, well, I'm sure you have saved a ton of more money. So how exactly should you go about saving this money, investing this money, as opposed to letting it lie? How can you sort of sum up that money and get that feel-good factor as well going? That's what we'll be discussing today in the first segment of the show. Later on the show, we will be getting on board our Meet Your Fund Manager segment, as we usually do on Tuesdays. Sailesh Raj Bhan, Nippon India Large Cap and Nippon India Farmers Fund Manager, will be joining us to talk to us about what to expect from these funds, and more importantly, the Pharma Fund, which is especially the cynosure of all eyes, given the fact that this space has really rocketed in 2020. But how tricky can it be to invest in a thematic fund? Well, we'll hear it from the fund manager himself. Later on the show, in our Spend with TMS segment, we will be bringing on board reviews of Vodafone Idea, or V as they have now rebranded themselves, versus Airtel versus Jio. How do each of these telecom service providers compare when it comes to their rates and when it comes to their internet quality and their quality of service? So it's an action-packed day right here on The Money Show. Without any further ado, let's get straight to it and bring on board our very first guest for today. It's Shweta Jain of Investography. Shweta, appreciate you joining us today on The Money Show. Thanks so much, for giving us your time today. To start with, it's not something that you can see instantly, but it's there. This money that we have saved because we've not gone out, we've not eaten out, we've not spent at movie theaters. Yes, maybe some of us have admittedly, at least I did, indulge in some online shopping. But yeah, I guess largely it has been quite limited, our money spending. How can one essentially put all these savings to use? And I'm sure the savings will be very visible in all our bank accounts or in our small shortened credit card bills.
Hi, Mobina. Thanks for having me. So yes, there have been savings that have happened due to lesser expenses in the pandemic, due to lockdown. But there are also pay cuts that we have seen. I want to just account for that also a little bit. So their savings might not be as much as people might have hoped. But the first thing that we should look at is cutting down on your loans. So wherever possible, with your savings, if you can pay off your loans, I think that's something that people should do. The second thing that people should do is have an emergency fund. I think this pandemic has emphasized on us more than ever of the importance of having a liquid fund, an emergency fund. We used to always insist that people have a liquid fund of at least up to 3 months of expenses. But I think 6 months, 3 to 6 months is a good number that people should definitely have. It may take a while for us to get there. To start accumulating is the first thing. So I think build that liquid fund for you so that you don't have to compromise on your goals or panic sell any of your investments. The other thing that this has showed us is that the importance of insurance, be it health or life. So you have to have adequate insurance. That is something that we have to ensure that we do. So yeah, these 3-4 things that people can definitely start off with. And like you said, some splurging may be needed for us to still feel good. So a little bit of splurging, I wouldn't say no to as well. But make sure that you're not spending it all, whatever you've saved, you're not spending it all right away.
Oh yeah, that's very important. I hope that yes, while of course you should sort of go ahead and spend a little bit of money, given the fact that we've all been in this lockdown, but that does not mean that you simply blow up your spendings disproportionately and really go on a bender, if you could call it that, over the course of the next few months. And I know how tempting as well that proposition could be, right? Because we've got the festive season as well coming up. So yes, it's quite a tempting proposition. But yeah, go easy, go slow. And yeah, just ensure that you are spending within your means. You mentioned earlier about the first thing to do is paying down loans. If you could just elaborate a bit more on that. So let's say if I have managed to save up a good amount of money by assiduously, ensuring that I am putting more away for savings versus I used to earlier, right? We have this often 40, 30, 30 or 50, 30, 20 rule. Now, of course, the ratios may have changed a little because, my discretionary spends have reduced. Maybe to some extent my essential expenses as well have reduced. Do you think, that a larger proportion of those savings should be used only towards paying down loans? I mean, should my quest be really to bring down my loan obligations to zero and only then invest whatever money I have left or saved?
No, I think it has to be a combination of both reducing your loan outgo, so you're reducing your EMIs, and building that emergency corpus, because while we may have been out of the main lockdown as such, but the pandemic is far from over. So it is really important that you build that emergency budget and not just focus on paying off that loan. So as long as you have that 3-month expenses sort of saved for your emergency fund, you can go ahead and pay off that extra bit on your loan, so that your interest outgo is lesser, your EMIs are then becoming more accommodative, that you can pay off, and you're closing off your EMIs sooner than later.
Okay. Shweta, now let's talk about students, whether they're undergrad students who are perhaps 18 or older students, 21, 22 and above, who are perhaps looking for postgrad. Now, we know that getting an overseas education can be quite an expensive affair because you have to pay for tuition, you have to pay for boarding, your day-to-day expenses over there. So, I'm sure many parents or students have been saving up for some time, to achieve the goal for overseas education. Many a times our viewers as well have this goal, right, for their kids, that, I want to save this money and invest this money for my child's overseas education. Now, all those plans have been either thwarted or they have been postponed indefinitely. So that's a big amount we're talking about, in lakhs of rupees. But again, how would you recommend they park their money in the meanwhile, assuming two circumstances? One, that their plan to go abroad is cancelled altogether for visa reasons or whatever, or two, just postpone until the next academic year.
So people have to relook at their goals right now. Then what do they want to do? So like you said, if they're just postponing for a year, then I would recommend that they do it in like an SBI liquid fund or an IDFC short-term fund. So any basically good quality short-term funds is something that they can invest in, so that this money is available to them when they really need it next year. But if they're looking at completely shelving this goal and not sort of going abroad for studying, then they have to relook at what they want to do. Do they want to then invest this towards some other goal? Do they want to start a business? And based on those goals, they should invest. I don't think they should be in a rush to sort of invest this anywhere, be it equity, be it or lock in basically. So anything that needs a lock in, I think they should think through more thoroughly. Meanwhile, they can just sort of invest this in short-term debt funds till they decide what they want to do with it. That's fine too, so that they're not letting this money be idle.
Exactly. It's important to not let the money be idle, and that's the the entire sum and substance as well, or the reason why as well we are having this conversation. In the beginning you mentioned, Shweta, that a liquid fund is a great asset class. Park all of these savings and these investments. I just want to know that is that the only asset class? I mean, what other asset classes would you recommend?
So short short-term funds are good too, short-term debt funds. I wouldn't say long-term debt funds for the sheer reason that, those are long-term in nature. So while it may still be debt, it is still long-term in nature. I wouldn't recommend like an FD, which is our usual go-to, because they will not make that much money considering the interest rates that are there today. And at least the PSU banks and the bigger banks are not giving you a good enough rate. So I would really recommend that they look at short-term debt funds for now, and not be sort of swayed by the way equity has performed, or swayed by the way gold has performed. I think that is really important, that you don't make some of these decisions just based on the short-term data that is there, because these are really long-term asset classes. So I would recommend that unless they know their time horizon, which if it's in years, say for the next 5-7 years, then absolutely they could go for equity even now. They could sort of stagger it, but otherwise for short term, right now I would recommend liquid and short term debt funds, also high quality paper, and not really just look at what has been the best performing short term debt fund, so to speak.
All right. Well, there you have it, folks. That's essentially all you can do to ensure that you're not letting your savings while away in a savings account, which will barely give you 2% returns, or perhaps even lesser. But you put all of your savings to work in an efficient manner, especially for those people who had some big upcoming expenditure, whose plans got thwarted because of COVID-19, be it an overseas education or be it some long holiday that you were planning to take but unfortunately cannot or is indefinitely postponed. Whatever it is, just ensure you park it so that it continues to sort of reap returns for you and it's not lying idle. Okay, we'll take on board some questions and queries. Then first up, we have Ganesh Joshi writing into us saying that I'm 40 years old, I have an income of 44,000 rupees per month and the only earning member of my family. I live with my mother, wife and a 9-year-old son. He wants to know if he should continue with his investments or should he change it. So he has 2 SIPs going. He has currently 2 SIPs going. One is an HDFC Children's Gift Fund, which is going on since 2015, and the other is the AB Sun Life 96 Tax Saver, which is going on since 2018. So there's roughly 94,000 rupees put between both of them, with 70,000 put in the Children's Gift Fund. He's got Access Liquid Fund, where he put in 40,000 rupees in April 2020, and he's got Access Blue Chip Fund. Okay, that's one more SIP that's going on, 1,000 rupees going on over there. Now his goals are, he wants it for his child's education, 20 lakh rupees, but that's after 10 years. Retirement of rupees 1 crore, that's after 20 years. He's currently owning a home that's in joint ownership name with his mother. The EMI is 8,244, but he wants to buy another home worth 50 lakh rupees in 2 years. So all in all, he's got, to be honest, he's got 3 funds, and I'm assuming that the Children's Gift Fund he wants to, I guess, keep for his son, who's young right now. He's only 9 years old. So a SIP in the Access Blue Chip Fund and a SIP of $1,000 again in the AB Sun Life 96. Plus they have a liquid fund, but that we would assume is for emergency purposes. Do you think that this would be enough, or do you think he needs to, perhaps buy more fund, increase his SIP amount? He's just got a horizon of 10 years and 20 years for education and retirement respectively.
So for the son's education, he needs about 8,500 or so to meet that goal per month. And for his own retirement, he needs about 10,000 per month. So he needs to start increasing his SIP investments, because this 3,000 is not going to get him there really. He should make sure that his SIPs are increasing. If he can't increase it immediately, he should increase it gradually and make sure that he reaches the 19,000 mark as soon as he can. The other thing about the house, the second house that he wants, I know the lure of a house and owning one more house where you get a rental income, but I would recommend that he postpone that for a bit, and until he sort of figures these 2 investments out, after which if he does have a surplus, then he can look at the second house as well.
Okay, so you could consider that decision, when it comes to buying a second house, perhaps try to postpone it for a little while. That's, Shweta's recommendation. She's also suggested some other chops and changes in your portfolio. Okay, we have next a query coming in from Chiduar. He says, I'm 30 and have a good risk appetite. I want to increase my corpus for retirement. And in fact, he believes that the valuations of many companies like HDFC Bank, TCS are cheap. He says that he's also already been investing in direct equity mutual funds via SIPs. He has cash in hand. He wants to invest further. So his question is, should he invest in mutual funds or should he invest directly in equity markets? So, it's interesting, Shweta, that he has the knowledge of things like valuations. He's already investing directly in mutual funds. He's taken the direct route. What do you think? I mean, when should a person essentially, if you could say, graduate from mutual funds to direct share investing?
See, I think a lot of us have this lure of owning direct equity stocks. We like sort of bragging about it. We like owning these and, sort of tracking the stock movements regularly. But I would really recommend that when we don't have the time or the expertise or both, to um, sort of make sure that we are disciplined in building an equity portfolio, I would really recommend that people stick to mutual funds unless they're doing this like on a full-time basis. They're doing research on a full-time basis. They're tracking markets full-time, which is usually not the case. We're doing our full-time jobs and doing this as a side activity, so to speak. You can learn about it so that when he does retire earlier, if he does, and then he can look at making sure that he builds a great equity portfolio as well. But I would really recommend that he sticks to mutual funds where their core job is to do this on a regular basis. Find stocks that have good valuations, that have good growth potential as well. He can look at mutual funds that are more concentrated. Maybe if he's looking to take on additional risk, or if he's just looking at tracking index, then I think index funds make a lot of sense, because if these are really cheap, which I'm not saying they are, but if stocks are really cheap, then people will see that and people will invest in them more. The prices will move, and being invested in an index fund will give him the advantage of all that plus lower costs. So which means that he gets to have his cake and eat it too. So I think that's a great way to do that. He can do lump sum investments as well. If he wants to do that, he can do SIPs regularly. And when he has bonuses or extra money to invest, he can do lump sum investments as well. But just make sure that he's not doing it in it for the short term, and is in equity for the long term.
Okay, so it's recommended that you stick to mutual funds rather than, going for individual, stocks. Interestingly, Shweta, during this lockdown, we have seen a lot of individuals go for trading in equity markets with the lockdown, and with the fact that brokerage houses as well and online brokerage apps as well have made the entire process so simple. I guess that's been a lure for a lot of retail investors. Okay, lastly, we have Gaurav Khandelwal saying that my income falls in the low income tax group as it's less than 5 lakh rupees. Now he wants to invest a lump sum amount in short-term debt funds with SWP to equity on a monthly basis of the return generated from the debt fund, keeping principal intact. Now he wants to know, from a tax perspective, what's more favorable, dividend or dividend reinvestment or growth, and should he opt for dividend reinvestment option for debt fund, or should he opt for dividend option and invest instead all the dividends to equities? So roughly he's trying to chart out a strategy where he puts his money first in debt and then slowly starts moving it into equity. That's what his plan is with the SWP, but he wants to know about the dividend bit and even the tax implications. Shweta, what would be your advice?
See, dividend distribution taxes come down last financial year, this financial year. So, which means people who are in the lower income tax brackets are now gaining more, because earlier it would be close to 30%. Now it would be in their tax bracket, whatever it is. So, does make sense for people to opt for the dividend option, and usually dividend reinvest is what is preferred unless the amounts are bigger. Otherwise, we'll see small amounts coming as payouts, but to keep it simple, and not keep looking at taxes, because what is there today might change next financial year, and his whole strategy will need to change, say, next year. I would still recommend like a growth option. And I would say that, whenever he needs to do a switch, he can do these switches to equity. He can still do an SWP to equity from debt. It doesn't have to be just from the dividend amount or the growth amount that he's seeing on his units, but a particular amount that he needs for his goal, because equity is for the long term, is for particular goals that we're doing. So I would recommend that he goes with a growth option and not really worry about too much, because tomorrow if his income increases, he'll still have to look at this as well. And usually with income increase, your work also increases. So this is not something that will be top of the head for him, saying, oh great, my income has increased, now let me move it from dividend to growth, at which time it's a transaction as well. So to keep things simple, I would recommend to go with the growth option, and that he invests in equity based on the requirement for his goal, rather than just say, okay, this much has increased, so let me move it to equity. So that would be my recommendation.
All right, well, there you have it, folks. Those are your questions and queries answered by Shweta Jain. Shweta, I'll let you go on that note. Thanks very much for joining in, and helping our viewers as well out with their questions and queries. Just to sort of summarize our conversation that we had earlier. First, take up all your savings and try and cut down your loans as much as you can. And yeah, if you don't have any loans, just make sure that whatever money you've saved is not lying idle, especially if it's big amounts, which you must have saved up for a lavish vacation during the summer or for overseas education. Make sure you park it either in debt funds, in short-term debt funds, in liquid funds, or if your goal is now far away, or you're not going to spend the money for a very long time, then perhaps in an equity fund. For now, we will take a very short break right here on the show.